Overnight, the Nikkei, the Japanese stock market, closed down 12.4%. It was the single largest decline in the Nikkei since the 1987 Black Monday crash. And so it was, fairly notable, to say the least. I woke up this morning, and S&P 500 futures at the time were off about 3%. They ended up being off around 4.5% by the time the market opened, and then through early trading ended up rallying a little bit to the point where they had rallied a couple percentage points, but we're still in negative territory. But the market is basically all red. There is not much green on the dashboard. Last time I counted out of the S&P 500, there were 20 stocks in positive territory.
Okay.
So things are not going well in equities today.
Anywhere
in the world, in any index.
Right. And it actually, we'll get to this, but it actually goes way beyond stocks, too.
So let's talk a little bit about what is going on and whether there's anything that the Fed should do, that the Treasury should do, that politicians should do, or that you should do. I think this is a good place to start.
In that order?
Yeah, sure, why not? What is going on? So, Friday, we got a jobs report that was slow. It wasn't good. 114,000 jobs added, and the unemployment rate went up to 4.3% from 4.1%. Two different reasons why this is bad. The first is 114,000 jobs added is basically the stall speed of the U.S. economy. If you get below that, you're not adding enough jobs to keep up with population growth.
Meaning unemployment's going up even without layoffs.
So that's not good. The other piece that's bad is the unemployment rate jumping to 4.3 leads everyone to spill a bunch of ink over something called the Somm rule, named for Claudia Somm, who was an economist. And the rule states that if the 3-month moving average of the unemployment rate moves up more than 0.5% past its low from the last year, you're in recession. Not recession's coming. Basically, you're in it right now.
Right.
And that rule triggered on Friday. Now, no one actually looks at this and says, okay, timestamp the recession.
Right. The conference board in Cambridge, Massachusetts does not say, oh, yeah, we hit a Somm rule.
It's the NBER who declares recessions. Yeah.
Declaring a recession because the Somm rule was triggered. But what she did as an economist was research and look for data mined effectively to go and look for, hey, what sort of things indicated in the past that a recession was here. And she found, well, after the recessions, this was not something she created in 1940 and then you followed along because she's still alive and doing economics today.
She is.
But it did find that, hey, in all the previous recessions, when this happened, it indicated, looking back, that we were in a recession right there. And on one hand, you might be willing to say, hey, a lot of these triggers that we've used previously, like the inverted yield curve, like ISM manufacturing reports, like the employment of temp workers, all of these have been flashing signals for recession over the last few years, and none of them came true. Should we just throw this one out? And the answer is no, you can't just throw it out. You have to take it seriously, and markets are now pricing in a more significant chance of recession.
So you've got this happening, and again, who knows if that recession's actually going to happen. It may not. I'm not here to tell you that we're definitely in recession or definitely not right now, because I don't think we are, and the next month or so, next 2 months, by the end of September, I think you'll know if there's going to be a recession before year end. That's because we're going to have 2 more months of data that is either going to say, hey, things are below towing and we're starting to rally, or hey, things don't look so good and recession's coming. We'll know in the next couple months. Here is why this is rattling world markets aside from the general idea that recessions are bad. The first, just at home domestically. The S&P 500 heading into the last couple weeks was trading at over 21 times forward earnings. Forward earnings are what the S&P is projected to make over the next 12 months. Historically, the S&P 500 trades in a range of 17 to 19 times forward earnings. That's kind of where you'd say, okay, that's a reasonable place to be. 21 times forward earnings is like, hey, everything's got to hit on all cylinders for these prices to be paid off because it's pricing in an awful lot of good news.
Goldilocks, just right.
So you had stocks priced very steeply to begin with. So any little wiggle about, hey, is there going to be a problem, means that has to, that premium for equities, you got to have some of that given back because it's just not showing up.
And I mean, fundamentally, just think about the price to earnings ratio. It is an equation, right? On the top, you have the price of stocks. On the bottom, you have the projected earnings there. And if you are worried about recession, you're worried about both of those things coming down. You're worried about the future earnings of those companies being impacted. You're also probably saying, hey, I'm not willing to pay quite as much for a company if I'm worried about an overall economic recession, even if that company seems like they're doing well.
So this is, part one. Part two. And this is going to get a little bit technical, but there's a reason why I mentioned Japan at the beginning of this. Japanese stocks down 12.5% almost. Why? What gives, man? What's going on in Japan? Did the Japanese economy suddenly worsen tremendously overnight? And the answer is no, it didn't. But when we talk about some of the things that hedge funds and other big investment vehicles do, one of their favorite things to do is what is known as a carry trade. Carry trade is a fancy way of saying, hey, if you can borrow cheaply in one currency and then buy something that's yielding more in a different currency, you try to do it because you can maybe make some money just doing that. And if you do it in large enough numbers, and if you leverage it to, hell and back, you'll be able to make some money is the theory behind it. So, in reality, let's say that you are a hedge fund and you say, hey, I can go to Japan and I can borrow at like 1% right now because they haven't raised interest rates in like 48 years or something like that.
They just raised them by like a 1/4% recently, right?
Hold on.
Okay.
So the premise of this is that the Japanese economy has just been very slow and sluggish for 30 years. So it's been very cheap to borrow there. And so you borrow cheaply. But remember, in order to borrow, cheaply, you have to have yen. So you go out and you say, okay, I got to buy a bunch of yen first, then, or I got to borrow them. But either way, I'm hedging my cost back to dollars. It's this whole complicated multi-leg trade. And then what I'm going to do with that after I borrow, I got to convert back to dollars, and I'm going to buy a U.S. Treasury that's yielding 5%. So I'm borrowing at 1, I'm buying at 5.
If the currencies don't
I'm not
move,
going to get that spread because there's a cost that you pay in order to hedge it, but that's the general premise of it. Why this matters is that last week, the Japanese central bank decided that they were going to raise interest rates for basically to a place that they haven't been in like 15 years. Again, it was just a small little hike. It was their second interest rate hike since 2007. Okay, again, they basically never hike rates. But they decided last week on Wednesday, the Bank of Japan said, yes, we're going to hike interest rates. 2 days later, jobs report comes in weak, U.S. rates go down. So, do the math out. You've borrowed in yen very cheaply. That cost went up. You are buying in dollars. The earnings that you're getting on that went down. The value of your trade is completely offsides right now. And so you end up with a bunch of hedge fund managers or risk managers at hedge funds pretty much tapping their traders on the shoulder saying, hey, we're levered 20-1 to this.
Run for the doors.
You got to get the heck out of everything, sell everything yen that you can, and batten down the hatches because we need to be the first one out so that we don't get hit by this. That is why Japan in this move here is kind of ground zero, is because it's a very popular trade amongst hedge funds. And so when they decide we're going to sell everything yen denominated, where previously, hey, we had to buy a bunch of yen or borrow a bunch in order to, facilitate this, that whole trade just unwinds there.